Hi, this is Elliot Eisenberg, consulting economist to American Pacific Mortgage, catching you up to date on the latest in economics. And well, look, there's a lot of stuff going on, inflation and supply chain problems. The single most important thing is the Fed. And the Fed's come out and said they're going to taper. We knew that they were going to taper, but we weren't sure exactly when they were going to start. But in the press conference and in the press release that came out after the last Fed meeting, they said they're going to start tapering in November. That's a little bit quicker than I might have thought. They might have said, oh, we'll start a month later in December. But no, they deliberately said this, and they also said they're going to continue tapering in December. So they're pretty proactive. And the reason is they don't know what inflation will look like next July. And they want to finish tapering as fast as they can in a controlled environment so that they're able to raise rates if necessary in July. So what they're going to do is right now, as we know, they're buying $80 billion a month in treasuries and $40 billion in mortgage-backed securities. They're going to reduce their purchases of MBS by $5 billion a month, 8 months, gone. They're going to cut their purchase of treasuries by $10 billion a month, 8 months, completely gone. At that point, they'll have taken their foot off of the fiscal monetary policy accelerator. So now it's pushed pretty hard. And over the next 8 months, they'll push less and less and less until by the end of June, they're off. At that point, they'll say to themselves, what do we do next? And Powell was very careful to say, look, we don't know what we're going to do next. It all depends on how high inflation is and what it's doing. Is it high and getting worse? Is it high and falling rapidly? Is it low? And he's saying, look, we don't know. As the committee, we don't know what's going to happen, but we want to position ourselves so that we have the ability to raise rates once or twice next year, 3 times, not at all. It will depend on inflation. And this is important because we were nervous that interest rates might rise. But because the Fed's calmed our nerves and explained to us that, hey, we're aware of what's going on in inflation and we know that it's a potential problem, but we're on top of it, we're going to pay attention and we're going to do what's necessary to tamp it down. As a result of that, long rates didn't go up, even though tapering is starting. Tapering is reducing the demand for mortgages and treasuries, which should, in theory, push up rates. But it didn't happen because we know in the long run, the Fed's taking care of it and watching the long-term inflation pressures and GDP growth. So as a result, nothing really happened and nothing's likely to happen going forward. Yeah, over the next year or two, rates will rise by 50 basis points or 75, maybe but certainly, 3 3/4 or something down the road, but nothing to go, oh my gosh, this is a replay of 1979 or 80 or 81. Really get those ideas out of your head completely. A little bit higher rates, maybe a little bit higher inflation, and then slowly tapering down as supply chain pressures go away and demand dissipates and so on. I hope this has given you some insights. I look forward to seeing you next month.